everyone, welcome back. Let's wrap this up on inventory, shall we? Chapter 5, Part 3, review for the final. Doing inventory under a perpetual system. I want to look at how it looks on financial statements. The income statement gets changed more than the balance sheet. An income statement can be done under two methods. It can be done under the single step, and it can be done under the multi-step. And we'll also peek at the balance sheet, though on the balance sheet there isn't much to say. We have a new current asset. On the balance sheet we have a new current asset. The current asset's name is inventory. It's listed with all current assets. And so let's consider the balance sheet done, shall we? Move on to the income statement. The income statement can be done under two formats. Either way, you're going to have your name of the business, the fact that it's an income statement, and the period covered. Forgot how to spell period. I need more coffee. And the first one I'm going to show you will be a single step, and you'll see how it gets its name. A single step income statement lists revenues all together. I only put down one, net sales. You've lost the detail. It just brings in net sales. Remember, that's minus returns and allowances and discounts. And then it lists expenses, putting cost of goods sold down as one. Lists them all together. Then you have net sales minus one number, total expenses, which includes everything, coming up with net income. It's done in a single step. Sales minus expenses, or revenues minus expenses equals net income. I did some good formatting here. $sign on top number, because it's a top number. $sign on cost of goods sold, first number in that column. Total expenses and subtract it from revenues, and a $sign on net income underlined twice to show the math's been checked. That's a single step income statement. Doing a single step or multi-step, of course, wouldn't affect the amount of net income, just how it's presented. So now I'm going to do another income statement for you, and this time it's going to be under the multi-step method. This one's more work, but I like it better. And like all income statements, it will start with the name. It will identify what statement it is. And then it will show the period covered. Let me put this on hold and drop a multi-step income statement for you. We list sales, show sales returns and allowances and discounts, and subtract them from that number, and show net sales. So the first difference is the amount of detail you're given for sales. You still get to net sales, but you see everything along the way. The next thing that happens is that we subtract cost of goods sold from net sales, and we show what gross profit is. Gross profit is then sales minus net sales minus cost of goods sold, and it's the amount of profit that we have left to cover all our remaining expenses. On the single step, it was buried in with expenses. On the multi-step, we've drawn attention to it and calculated the amount of gross profit. Gross profit isn't a count, it's just a line item. After gross profit, we list operating expenses. Sometimes we break them out into their selling and administrative components and list those separately. I just listed totals, and then we subtract total operating expenses from gross profit to get something called operating income. A lot of people think that's a good number to know. And so this draws attention to that. And it's my favorite part of the multi-step income statement. This is how much money you generated from your operations. That which you can expect to be there in the future as you move on. Then if you have other revenues and expenses, that comes next. And I threw an interest revenue and interest expense just so we'd have a couple lines there. You might also have gains and losses for sales of investments or property, plant, and equipment. But that has nothing to do with ongoing operations, so they're listed under it. And then those are netted and totaled and either added or subtracted from operating income, whether expenses are more or less would determine on how that would go. And then you subtract or add that and you get to net income. Net income would be the same under either approach, multi-step or single-step, but it would be shown differently. The multi-step gets its name from how many steps it takes to come up with it. First you come up with net sales, then you come up with gross profit, then you come up with operating income, then you come up with net income. And it's done in multiple steps. The single step is done in just one. Revenues, one number, expenses, one number, net income, one number. Bam, bam, and bam. Down and dirty. So, that's a good review of multi-step and single-step. Let's finish this up by looking at ratio analysis. People are up and wondering about my house now. It's not really early in the morning anymore. Discussing how the Bears are going to do in the football game and other important items. So just ignore the background noise, will you? Let's look at ratio analysis. We're only going to look at one in this chapter, the gross profit ratio. It's sometimes known, probably more often than not, as the gross margin ratio. And it's calculated by taking gross profit and dividing it by net sales. We'll do a couple other ratios in Chapter 6 that will complete our way of sending information to outsiders. Let me draw a little income statement for you here. Let's say that we have net sales. So returns and allowances and other items have been deducted. And that we have cost of goods sold in the amount of $8,000. So our gross profit ends up being $2,000 in this example. If sales are 100%, what would cost of goods sold be in relation to that? Well, 8,000 divided by 100,000 would leave that being 80%. What would the gross profit margin or gross profit or gross margin be? And that would be 20%. So it's basically taking the first three lines of the income statement and turning them into ratios or percentages to calculate this ratio. And our ratio we were after is the gross profit ratio being 20%. The way that would look if you were to draw it out in the formula would be 2,000 divided by 10,000. The way it looks if you calculate it off of an income statement is shown below. I think if you learn how it looks on an income statement, that helps you know what to do mathematically. You look at gross profit over a period of time. So you do a trend analysis with it. And you compare it to outsiders. So you can look at the industry and how a business compares with an industry. You'll recall in Chapter 1, we started our study of accounting by saying we were going to make financial reports, income statements, owner's equity statement, balance sheet, cash flow, and notes, and pass those to outsiders, external users, people outside the organization, and that they would look at them and interpret them and make decisions based off of that. Do they want to invest in this or lend this money or not? And the gross profit ratio is one of the things they can look at. They'll look at it over a period of time. So if we were looking at 2011, 2012, and 2013, this ratio doesn't change much over a period of time. It really doesn't, because people get a policy going for how they mark up stuff. And then they kind of live with it. So it doesn't change much. And you would want to make sure for your company you're looking at that it's holding constant. In my example, it goes up a little, it goes down a little, but 2013 just looks in line. A more telling story would how it would compare to the industry. So you could get industry averages from a bunch of different places, easily found. If you go to a library, go online. Let's say industry averages are running around 19%. Add a little consistency to them. How do we compare to the industry? Well, we consistently have a higher gross profit than the rest of our industry does. And what that says is we're generating slightly more money off of every sales dollar to cover our remaining expenses. In this case, you would say we were outperforming the industry for every year examined. That would be positive information. Ratio analysis, once we get through with it, will either make you feel warm and fuzzy or cold and prickly. Do you want to invest in this company or not? By the time we're through, I have about 17 different ratios we'll look at after 1120 is done, and you'll be able to take financial reports and as an outsider review them, and you will definitely land in the warm and fuzzy or cold and prickly count when making decisions. This completes, finally, my analysis of Chapter 5. Thanks for joining me. Have a great day.